Hey there, financial enthusiasts. Welcome back to Investment IQ Insights, your go-to channel for smart financial and investment strategies. Today, we're diving into a topic that affects almost every aspect of your financial life: credit scores. Whether you're looking to buy a house, get a car loan, or even apply for a credit card, understanding and improving your credit score is crucial. In this comprehensive guide, we'll break down the fundamentals of credit scores, explore what factors influence them, and discuss practical steps to boost your score. But before we get started, make sure to hit that subscribe button and leave a comment below saying "I subscribed," and we'll do our best to respond to as many comments as possible. So, let's get started. Section 1. What is a credit score? First things first, what exactly is a credit score? Your credit score is a numerical representation of your credit worthiness. It's a 3-digit number that ranges from 300 to 850, with a higher score indicating better credit worthiness. This score is calculated based on various factors, and understanding them is key to managing and improving your credit. Your credit score is not just a number. It's a reflection of your financial habits and responsibility. A good score opens doors to favorable financial opportunities, while a lower score can make borrowing more challenging and expensive. Section 2. Factors influencing your credit score. There are several factors that contribute to your credit score. The most important ones include: number 1, payment history, 35%. Timely payments on credit accounts, loans, and bills are crucial for a positive credit history. Late payments, on the other hand, can significantly impact your score. Number 2, credit utilization, 30%. This is the ratio of your credit card balances to your credit limits. Keeping this ratio low, ideally below 30%, is beneficial for your score. Number 3, length of credit history, 15%. The longer your credit history, the better. It shows lenders that you have a track record of responsible credit use. Number 4, types of credit in use, 10%. A diverse mix of credit types, such as credit cards, installment loans, and mortgages, can positively impact your score. Number 5, new credit, 10%. Opening several new credit accounts in a short period may be perceived as risky behavior and can negatively affect your score. Section 3. How to check your credit score. Now that we know what goes into a credit score, it's important to regularly check your own score. Many credit card companies, banks, and financial apps offer free access to your credit score. Reviewing your score allows you to catch any errors and monitor your progress as you work to improve it. Checking your credit score isn't just about keeping tabs on your financial health, it's also a proactive measure to prevent identity theft and address any discrepancies in your credit report promptly. Section 4. Practical tips to improve your credit score. Improving your credit score takes time, but it's absolutely achievable. Here are some practical tips to boost your credit worthiness. Number 1. Pay your bills on time. Set up automatic payments or reminders to ensure you never miss a due date. Number 2. Reduce credit card balances. Aim to keep your credit card balance below 30% of your credit limit. Number 3. Don't close old accounts. Closing old credit accounts can shorten your credit history. Keep them open even if you don't use them often. Number 4. Limit new credit applications. Each credit inquiry can significantly impact your score. Only apply for new credit when necessary. Number 5. Diversify your credit mix. If possible, have a mix of credit types such as credit cards, installment loans, and mortgages. Remember, improving your credit score is a gradual process, so be patient and stay consistent with these habits. Small, positive changes add up over time and can make a significant difference in your credit worthiness. Section 5. How a good credit score benefits you. Now that we've covered the basics of credit scores, let's talk about why they matter. A good credit score opens doors to various financial opportunities, including: number 1, lower interest rates. With a high credit score, you're likely to qualify for lower interest rates on loans and credit cards, saving you money in the long run. Number 2, better loan approval odds. Lenders are more inclined to approve your loan applications when you have a solid credit history, giving you more options and better terms. Number 3, higher credit limits. A good credit score may lead to higher credit limits on your credit cards, providing you with more financial flexibility. Number 4. Favorable insurance rates. Some insurance companies use credit scores to determine rates for auto and homeowners insurance. A good score can result in lower premiums. Number 5. Employment opportunities. In certain industries, employers may check your credit as part of the hiring process. A good credit score can enhance your job prospects and career opportunities. As we wrap up today's in-depth exploration of credit scores, remember that your credit score is a valuable asset that can shape your financial future. By understanding the factors that influence it and taking proactive steps to improve it, you're setting yourself up for success. If you found this video helpful, don't forget to give it a thumbs up and share it with someone who might benefit from this information. If you haven't already, make sure to subscribe and ring that notification bell for more content on personal finance, wealth building, and economic insights. Thanks for joining us today on Investment IQ Insights. Until next time, stay financially savvy.